Hey everyone, and thank you so much for tuning in to another episode of the Sage Investor webinar. I'm your host, Jin Wang, and I am one of the three partners at the Sage Investing Group. My partners and I, we are former Big Four auditors turned full-time multifamily syndicators and operators. Our mission is to empower other risk-averse investors, much like ourselves, to diversify their portfolio with cash flowing and appreciating assets such as apartments. If you're interested in learning more or working with us, we encourage you to set up a call on our website at sageinvestinggroup.com. So today we are very excited to welcome the CFO of our property management company, Brian Hay, to the webinar. Now, before I introduce him, just want to go over the agenda really quickly. I'll make the brief guest introduction, and then we will jump right into our conversation with Brian today. And then toward the end, I will give you, the audience, an opportunity to ask your questions. Please type your questions into the chat box, or you can unmute yourself and ask when we open up the floor for Q&A. So the webinar should be completed in about half an hour to 45 minutes, depending on questions. And so without further ado, let's get right into it. So here is Brian. Brian is the Chief Financial Officer at MultiSouth Management Services, which is a highly regarded property management company based in Memphis, Tennessee. So with a focus on the Southeast, MultiSouth currently manages over 11,000 units across states such as Tennessee, Mississippi, Missouri, Alabama, Florida, Kansas, and Arkansas. Brian joined MultiSouth as a CFO in 2018. And before this, he started his career in public accounting at KPMG in 2006. So he is a certified public accountant as well as a chartered financial analyst. So it's been invaluable having Brian with his CPA and his CFA background as our property manager. Together between Brian, Tim, who is our asset manager, and the three of us at Sage, who are auditors, I have to say that we have an extremely financially literate and detailed-oriented team. So I'm very excited for this opportunity today to talk to Brian about property management and just to hear his insight about the state of multifamily today. So welcome, Brian. Aside from what I shared already, is there anything else that you would like our audience to know about you?
Well, I would say thank you for the introduction, and I'm laughing because you can tell I'm an actual accountant because the picture you have up right now is me in a standard white or standard light blue t-shirt or a dress shirt, and I'm actually wearing the exact same shirt again because I'm a boring accountant. So I laughed as you were introducing me just looking at that. No, it's great to be here. I appreciate y'all inviting me onto the show. I've only done one of these before, but I got to say y'all's was for your introduction and your platform is much more polished than the last one I was on. So congratulations on that.
Thank you. That's really nice of you to say. Yeah, we've done this several times now. So trying to get the hang of it every time we do one. So yeah, thank you so much for joining us. Really appreciate your time. Let's get right into it. So let's get started with the basics so that we have no investors left behind. Maybe you can explain to us what MultiSouth as a property management does.
Sure. So we're actually a little bit of a unicorn these days because there's not as many just strictly fee management companies out there. I feel like that area is growing simply because there's a lot of syndication happening in the market. But in general, most folks, like we're the biggest fee manager in Memphis. There's a lot of other managers in Memphis, but they're usually owner operators. They have a partnership group that's maybe an equity team. So we're a little bit different. I like to say, we're the property management assassins. You find something, you're just there, you really want to make it a passive income. And the only way to do that is not be tied down to the property all the time. So you have a good asset manager like Tim involved. And I'll give a shout out to Tim. We've worked with a lot of asset managers, and Tim, being new to the business, is very sharp and I think brings an interesting, background to it. He doesn't come from the real estate world. He came from a different world, but very sharp guy, and he's taken to it like a fish to water, and he's been very helpful. He does stuff for us as an asset manager that people that have been asset managers for 30 years still don't do. So you mentioned being a very financially literate team. Tim falls in that category, and I think that's extremely important. And it's also important for all y'all to know that your asset manager should be hands-on, not just preparing reports, being in the background. They should be at your properties on a regular basis. As a manager, we don't always love it, because as much as we try, we'll still miss things, or depending on who's on site when and what's happening, something can get missed. But that's the point of your asset manager, is that they're that extra step of, hey, I went to the property on my quarterly visit and I saw these three things. So guys like that, girls like that, whoever it is, a good asset manager is invaluable, just like we like to think that a good property manager is invaluable.
Yeah, that is certainly right. We're all a team. We work together to make sure that the asset is performing, and each of us do our own parts. But definitely very important for everybody to be hands-on and to be, all hands on deck.
Mhm.
And so just kind of curious, I know some people out there, they don't really understand kind of the structure of the property management
Mhm.
company. So for you guys, can you kind of explain about your regional managers and things like that?
Yeah. So generally speaking, we're going to have people in the corporate office that provide support to our regional managers, which is kind of the head field person. So we have a regional manager. We are different in a little bit, that our regional managers, we don't like them to have generally more than 1,500 units. And that kind of depends on what's happening in those properties. If you've got 5 stable properties and they're all fully occupied and they're all 400 units, then that person can probably manage 2,000 units fine. But generally speaking, in this market, people are doing a lot of value add. So those can require more effort, more just hands-on, and just, when a property's at, let's say we've got some that we take over that are 40% occupied, that can be a handful. You've got others that were at 95 and we're taking them down to 75 to work on units. So things like that can change. So regional manager is important. Their history of whether or not they've been on a renovation project before can be important. Most of ours, I believe, have at this point. We have maybe a couple that have it, but we've got 9 regionals, and of those, I would say 7 have had pretty good heavy work experience with doing renovations. Below them, you basically have your property staff. So you're going to have a manager, assistant manager, a leasing agent, and your entire maintenance crew. Depending on the size of the property, you might only have just a manager. They may be the only person in that office, and they run the whole show because it's 110 units. Generally, once you get over 100 units, so you're going to have 2 people in that office. It's going to be a manager, and depending on what you need, it might just be an assistant or it might just be a leasing agent. If you have sort of kind of like you guys have, you've got 3 properties that are close to something, then maybe you can have like a manager at one spot and then have an
Mhm.
assistant at another one and a leasing at another one if you want to have office presence. Maybe the third one doesn't have an office, so people have to come report to the other offices at another site. But generally speaking, the corporate structure starts for us at the regional level, and then it moves up through our operations here in Memphis. So they're kind of the connectivity between us and the site.
Mhm.
They're out. I mean, Dave and I joke all the time that we walk down to the regional desk and it's like, where is everybody? But it's a
Mhm.
good thing. It means they're supposed to be at least out at their sites, talking to their people, training their people, seeing what issues are coming up, walking the property, that sort of thing. We're doing some new stuff with our regionals in terms of quarterly and monthly property inspections. We're using one of our new tech firms called HappyCo to kind of automate that, and then there's going to be peer reviews, different things like that. So, and the peer review is not because nobody's trusted. It's just that sometimes you go to your site enough and you forget that that little piece of the property kind of looks rough. It's just like walking into your house. You just get used to it and don't think about it anymore. And so we like to have a fresh set of eyes come by, which is also what your asset manager is supposed to be doing. So a lot of people think these things are set it and forget it. The money's coming in, but these are properties are living assets. Like they are depreciating every day in terms of their condition. A storm can come through and knock something over that wasn't there the day before. So if you want to maximize your rents, maximize the potential, you need to be ready to spend money to fix things. And it's not always a lot. It can be little things, but you just need somebody to pay attention and be there on a regular basis.
Yeah, that's great. And so you mentioned that the regional manager, they go out there to visit the properties. How frequently do they usually go visit?
Our properties, if the regional manager isn't there 4 or 5 times a month, then something's
Hmm.
wrong.
Yeah, that's really good. So I guess can you tell us what else makes like Multi-South unique? What else do you guys offer that make you guys unique?
So we've actually grown a lot in the last 4 or 5 years
Mhm.
for a couple different reasons. One of the main reasons is we had a pretty strong work crew before kind of the value add trend started, that we would do fire renovations. So, if something burned up or you needed new roofs or whatever it might be, that we would do that work for you. And we had our own crews. And we kind of grew that as the value add started. We've really worked extremely hard to develop the relationships with vendors to make sure we're getting the best price on everything. Um, COVID created a lot of challenges in that category. So we would sometimes know the best price, but hey, it's 6 weeks before you can get it. And so then you had to we leaned really hard on all of our vendor relationships. And we try not to ever get into getting stuck with just one vendor. I like to have backups. So all of our flooring guys, I've got 3 people that provide flooring. And when one of them goes up on price, I call the other 2 and say, hey, your price is still good. Yes, we can keep them there. And then I go tell the third guy, hey, we're going to have to stop using you because your price is too high. And they usually kind of change their tune and they say, oh, well, we can figure something out. We'll get that price back down. So it's good to have competition. And so what we did is we developed that aspect of it. So now we can help you guys with rehab. It also helps the flow of the project usually, because we're in control of the contractors. We're in control of the access to the units. We're looking at lease expirations. It's just a little bit easier. We still use some general contractors in some places just because, labor market's tight and can't always find enough guys and there's a lot of work to be done. But we've developed pretty good relationships there too. But we have 3 superintendents, about to have a 4th, that work for us, and they strictly oversee the renovations. And so it's kind of the owner's advocate. And, a lot of times a regional can do that, but the regionals usually have a lot on their plate. And so even like just the operations of the property. So asking a regional to manage a renovation project is kind of a heavy thing to do. And sometimes that expertise doesn't really line up. I mean, they might have had good expertise in property management. They could have been regional for 15 years, but they don't really know if a wall's getting framed up wrong. They don't know if that HVAC is being installed wrong. So we have guys whose their entire career have been general contractors. And so we brought them in-house. They manage the subs, they negotiate the contracts, they make sure the work's being done properly. They walk the units before they get turned over. They do a lot of little things that they work real close. I mean, they basically work as close as they can as anybody covered with the regional. So their go-between is the regional all the time. So the regionals know our superintendents really well. They work well with them. There's always personalities that mix and match and things like that. So it's fun to manage that sort of process. But once they get here, some of our superintendents are newer, and so you got to get used to personalities, how they work. We've got one guy that loves emailing. We'll send a million emails. You got another guy, couldn't get him to send an email to save his life, but he's really great on the phone and he's always up to date on his projects and he knows where everything is. So, and that's a little bit due to the fact that he's been a contractor his entire life. He's never sat behind a desk. So asking that guy to send a million emails and fill out spreadsheets can be tough. So we have back office support that'll help with that. Get on the phone and talk to one of our guys in financial reporting and help true up some sheets and stuff like that. We also, on that note, we manage the draw process for you guys. If you were getting the money back from your lender, they gave $2 million to do the renovation. We'll handle that project for you seamlessly. The invoices are coming to us. We're storing all the invoices in Resman. You can see them. And so it's a very transparent process. We are, in my opinion, very different than hiring a general contractor because we charge cost plus. So everything that costs you money on the site, where you're going to see it in your CapEx expenses, it's going to be below the line. And you're going to see, you can literally look at the invoice yourself. You're going to see exactly what you paid for, exactly how much you paid for it. And then we simply add a cost to it each month, put it in your financials. We make the draw to the lenders. And so it's a very seamless process for you guys. If you hire a general contractor, what you're going to get is a price from them. And they're going to say, oh, we'll turn these units for $13,000 or whatever it might be, maybe more than that. But they're not going to tell you what their costs are. They're not going to tell you how much their supplies are. And generally speaking, I mean, and don't get me wrong, these guys got to make money too. But I'll tell you, their fees are usually 25 to 30% on labor, and their fees are usually 20 to 25% on materials. And so I mentioned earlier, we do use general contractors, but when we do, we hire them for labor only. So whenever we bring in those guys to do that work, we're going to make sure the supplies are on site, and we're going to provide all those materials because we get them at great rates. We have huge relationships with Lowe's, Home Depot. We kind of, I guess we pick lanes for people to be in. All my HVAC equipment comes from one place right now because they have the best prices. All of our appliances come from another place. and they're the suppliers to Lowe's. So, we talked to Lowe's about getting us appliances, and they said, sorry, we can't beat the price that you have because that's actually our supplier too. So where we can kind of develop those relationships, get the best pricing, and kind of keep people in their lane to provide savings to you guys, we do. And we work really hard to keep that going and develop those relationships. And if we think there's a place to go to get a better savings, then we'll start looking at relationship and try to get it for you guys.
That's awesome. Yeah. So I hear a lot of benefits of having an in-house construction team, which is, one of the advantage you guys offer. One of the things that's unique about your company. So that's really great because having experience on other projects, it seems like it just makes the communication, the renovation, the value add aspect of the asset a lot more seamless when it's all kind of coming from, the construction team is the same as a property management team. There's like really no conflict or no confusion on like who is supposed to do what to get the product to, a rentable state for new tenants.
That's right. You mentioned that. I hear a little bit of that every now and then of, well, so-and-so was going to do that, or so-and-so was going to do that. If it's all under one house, it doesn't really matter. We need to get it done. No matter who on our team is supposed to be getting it done, it's going to fall in our wheelhouse. So it's usually easier and things get pushed forward a little bit sooner with that because they know it's our job no matter what. There's no scapegoats. It's us.
Yeah, you can't put your fingers on someone else.
That's right. It's terrible at times, but it's the best way to do it.
Yeah, I'm definitely seeing that. Well, awesome. Well, thank you so much for sharing, so much information about MultiSouth and the team and kind of like how you guys run and how you work. So now let's kind of move on a little bit to kind of the state of multifamily. So from your experience, can you just tell us, some of your observations since you're like more boots on the ground? You're closer to these properties and you're much closer to the regional managers. And just talking to everybody, like in your experience, like, how has the apartment rental space changed since the onset of the pandemic?
It's funny. I was talking to a fellow about that last night. I described it as the COVID pandemic being just one of those, people always talk about black swan events, like something that everybody thinks they planned for. But when it happens, you're like, my God, we never thought about this. And to us, that black swan was everybody's got a Fannie or Freddie loan, basically. And if you had that, you were still required to pay your mortgage, but you couldn't require your people to pay rent, and you had to leave them in there. So it was a scenario that nobody had ever been in before. I mean, usually if it took you 90 days to get somebody out, that was a long time in Memphis, Tennessee, and generally in the Southeast. People in California, I feel sorry for them, but them staying a year or two was no unheard of thing. Like, it happens all the time. That's just how the laws work. But for here, it was unusual. We actually, I'll say this, I was pleasantly surprised by the ability or the willingness of our tenants to pay rent during that time when it was generally kind of known that you didn't necessarily have to pay rent and they weren't going to kick you out. We didn't see a really big drop off. What we saw a drop off then was late fees because we weren't allowed to charge them anymore. But we didn't really see the delinquency start adding up probably until 6 to 9 months ago. For the first 12 months of the pandemic, it wasn't that bad. As it started to get worse, the state funds were kind of kicking in. They were figuring out how to get them out to tenants, which was nice. We're still getting a little bit of that now, but we've kind of gotten to the point where we're not really, kind of the leniency is gone. It's everybody's getting evicted at this point if you hadn't paid. And so it's kind of getting back to business as normal. But even then, you guys know, the courts still necessarily aren't processing things like they were. So the way it's changed for us, the first thing that happened to us is we used to kind of be on the fence about ACH payments. The day the pandemic hit, or not the day, but shortly after, a month into it, when we were having to close our offices on a regular basis because somebody was exposed, and it would be 10 business days before we were allowed to open our office again, we immediately said, this is a great time. It's the time. Everybody goes to ACH today. And so we pushed out that. It's shocking to see which sites take it up and which sites don't. We're like I said, a fee managers. We manage kind of all levels of property. We have plenty of A class. We have plenty of B class, and begrudgingly, there's probably a hair of C somewhere along the way, depending on what state the property is when we take it over. But, a B class property, some of them I thought never in a million years would we be able to get them on ACH quickly. We had a couple of them that were 95% ACH within 60 days. And part of that is because of the way our ACH system works is you can still go use a money order. It's just that when you go to do the money order, they send the ACH for you. So instead of them bringing the money order to us, which was not a credit risk, but basically a fraud risk, if you had a manager that wanted to misapply it or send it to the wrong place, et cetera, you could have some risk there. And so for us, it was great to eliminate that. And I think you're going to see, if you haven't already, a lot of the apartment world be ACH. The touchless payment was, like I said, a little bit of an excuse. We leveraged it into getting ACH payments, but it's been great for us. That was the first big change. We're also looking at a few other things. We wanted a little more security because, like I said, it used to be 60 days, 90 days was a long time for us. And so we're using a new product called Rhino, which is a security deposit replacement. It's basically a fidelity bond on a renter. We're giving folks the option, I think, because legally we have to, but you can either give us a security deposit or you can use a product called Rhino. I think there's a couple of the players in the market. We've opted to go with Rhino for our company. All they do is basically give them a soft credit check underwriting. And then if they're approved, they, instead of paying a $300 security deposit, they pay $9 a month and we get $1,000 of coverage. What I like about it is it gives me more coverage than a security deposit. It's a good alternative for the renter because it may not cost them as much on the front end. Now, the $300 security deposit is refundable. The Rhino fees are not refundable. But a lot of folks would much rather just pay $8 or $9 a month rather than give you $300 or $400 or $500 up front. So that's good that we give them an alternative. But most importantly for me, I'm giving hopefully my owners more coverage. If I'm getting $1,000 or $2,000 of coverage through that fidelity bond, if something goes wrong or I have to kick them out, I'm going to have 2 months of coverage possibly. And then, so if you're conditionally approved, whereas before we might take a $600, $700, $800 deposit, now we're doing 2 times rent, so it might be up to $2,000. So that's the long-term plan. There is just to provide more coverage for our owners. And so little products like that we're starting to see trickle into the market that makes sense for us.
Okay, cool. That's really great that you guys are very forward thinking and, just thinking of ways to, prevent problems based on what you've experienced during COVID.
I'll tell you this, there is there is so much technology. And I think it's what you're seeing, like multifamily has always been a big industry, but with the onset of commercial going downhill, I think the 2008 pandemic kind of crashed the stock market a little bit. You started to see more people looking to this as a passive income and vehicle. And so you ask the brokers, you ask the owners, the world has changed. Like the multifamily investment world has changed. There's a lot more players in it. There's a lot of syndication out there that wasn't there 15 years ago. And so with that comes apparently a lot of technology. It's been great. Like we're moving all of our legacy stuff that was on AMSI for Resman, which is new technology. But I joke about it. I literally get 5 to 10 a week and sometimes 5 a day emails from new products. Let me tell you about what we could do for your multifamily through this, and this. Most of it is garbage. So don't be tricked. But there are some that stand out every now and then. And like I said, Rhino is a good example because it used to be, I think it was Sure Deposit was the old version of this. And the problem with Sure Deposit is no matter how many funds were paid in, the pool of funds you could take back from Sure Deposit was only your property. So if your property sent $15,000 in fees, the most you'd ever get back out was something like 70% of that. And so you would never get as much money in as much money back as you would by taking security deposits. So it didn't really work. With Rhino, the pool is the entire company, the entire properties everywhere, United States. There's no limit. So even if I've got, if I've only sent in $20,000 in fees through my tenants, I can go pull back $100,000 if I have $100,000 of claims. They're looking at it at an aggregated basis. They're writing off all of their fees and everything based on those, all of the people they're underwriting. So I've asked them pretty bluntly how they make money in this business, and their answer was that most A-class properties don't make that many claims. Everybody loves to pay the fees because nobody wants to pay a $1,500 deposit or a $2,000 deposit, but they're more than happy to give them $6 a month. But they say 95% of the A-class properties, they won't make claims. So they're making money. If you've got a B-class property that has higher claims, they don't mind. It works for them in aggregate, and it works for you as an owner. So everybody's happy. So it's that kind of progress I think we're seeing in a lot of areas that has been a recent event, and it's great for the industry.
Yeah, I agree. No, we get tons of emails as well with various vendors asking us, wanting to speak to us. It's a lot of work managing those. But
Yes.
yeah, in terms of that program, the Rhino program that you're talking about, the fees are the same across the board, right? A, B, or C class properties.
No, they're not.
Oh,
They actually underwrite the individual, and I think a little bit to the property, but they're not big. So like they're not big differences. So like if you're in a B class property, $1,000 of coverage might cost you $7,
hmm,
whereas it's an A class property where you don't have a high risk, it may be that $1,000 of coverage only costs you, 550 or something like that.
hmm.
But the way it works is whenever you sign up for it, they tell you 12 months of coverage will cost, $163. We're going to charge it to you over 12 months. Oh, another great benefit. A couple of them actually is one, you can make a claim while somebody is still in the unit, which is wonderful. While you're waiting for eviction, you don't have to worry about cash flow. And two, since it's a fidelity bond, it's basically an insurance product. And so if the fee is going to be $100 for 12 months, if they make the first payment month one, then you're covered for the entire, it's actually 14 months because they give you 60 days past the lease date. So even if that person only gives them $8, let's say it's a complete deadbeat and they're like, oh, I'll pay month one so I can move in and then I'll just never pay it again. Doesn't matter to us as an owner. If they never pay it again, doesn't matter because we won't move them in until they've made the first month's payment because that's how the security bond gets locked up. And once we get that approval from Rhino, we give them the keys to move in. And then if they never pay rent and never pay Rhino ever again, doesn't matter because we're still covered.
Okay. Yeah, that's really cool. So I guess on another note, like I guess relevant to tenants, as we all know, rents are rising pretty much everywhere.
Mhm.
And in the Southeast, we see like double-digit rent growth over the past year or so. So I just kind of curious, what type of trends or patterns do you see occurring in tenants as these rents are rising?
What do you mean exactly about trends and tenants there?
Like in terms of like, do you see any differences in how people are like I guess in terms of like how tenants are applying for apartments or like the demographic of tenants applying for these
That
apartments units?
that really hasn't changed too much.
Hmm,
It's a lot of the same people. One thing COVID did for us, at
hmm,
least in Tennessee, was it raised wages. When people stopped working to go find workers, they had to raise the wages. So that's been nice to have because we have been raising rents. And COVID kind of, I mean, you guys probably saw it. If you had a paying tenant and they wanted to stay, we didn't really raise rents that much. We kind of had what I would call a rent increase furlough during COVID. In the beginning of 2021, if you were on time and paying rent and you wanted to renew, baby, we were going to keep you because finding people that wanted to pay was tough to do. And so um, when 2022 started, we were given big increases everywhere. It's forced a little bit of turnover, but really not as much because I think people were expecting it. And like I said, wages have come up. And so we hadn't seen the demographic change really at all, at least not in our communities. You're getting a little bit of pushback, but frankly, we're not seeing as much pushback as you would expect. A
hmm,
lot of where we're raising rents we're doing the upgrades. And frankly, we're getting more of an increase than we expected. Um,
hmm,
a lot of people a good example is one property that hasn't really changed much in 20 years, had a 99% occupancy, new customer bought it. We told them we were going to do upgrades. They wanted to get $100 more was their pro forma over the next 24 months. The day we got there, we raised rents $100 across the board. Nobody even said anything. We had a waiting list from the last owner anyway. People
hmm,
didn't care. And then we
hmm,
said, hey, we're going to renovate the unit. We're going to raise another $150. People said, oh, these are nice units. We've got new floors, new appliances, etc. We also gave them an option of, hey, if you want new stainless steel appliances, we'll give you those, but it's going to be a $75 increase on your rent, which if you do the math on at the time, it was a $1,200 package of stainless steel. That's a great payback. And so we had probably 3 out of 5 renewals would select
hmm.
that. And then you'd have one person that would go away and then we'd go renovate another unit. But we were getting big increases. I think we're already 100 to $150 ahead of their pro forma. So they're happy there. Um, the renters are a lot of the same.
Hmm.
We like to, I've always kind of told my buyers to think of their apartment complex as kind of like a nightclub. I was like, you want to be the newest, most renovated, nightclub on the block because there's always choices where to live. And so you want to be just a little bit different, whether it's, your landscaping is just a little bit cleaner, or you make sure your tickets get punched within 24 to 48 hours, or whatever it is, word gets around that, this property's a little bit better than that one next door. And we see that a lot. So we go out and we hang the velvet rope and say, you can't come in here unless you have this qualification, and these are how much the rents. If the rents are higher, a lot of times it kind of takes care of itself, because they're going to expect more if the rent's higher, and if you're delivering that, they're fine. And usually the people that are willing to pay more are your renter. That's who you want. So it's a little bit of a self-fulfilling prophecy in that regard, but you still have to do all the things to make sure people are willing to pay that amount. And so I don't think the renters really change. It's just we're always looking for the top 25% of the renter in that market with our properties. Right. We're trying to be just a little bit better.
Right. And every time, the tenant churns, it's an opportunity to essentially improve upon that tenant base at the property.
That's right.
Yeah. Yeah, that makes
That's
sense.
Right.
Well, that's good. Definitely good to hear that, there hasn't been, pushback from renters on the increased fee, because as long as you're giving them, a reason to pay more, right? With renovated
We'll
products.
say this. I will say, yes, you're right, but there's usually pushback, and we get this. We get a lot of different personalities in our business. So, and it could be your leasing agent, your assistant, your manager, your regional. Whenever we say, hey, go raise rents. So, well, I'm getting a lot of pushback. Okay. I said, well, that's good. I said, how many pieces of traffic did you have? We had 5 pieces of traffic for one apartment. So, okay. So 3 people said no, and 2 people said yes, or 1 person said maybe, and 1 person said yes. As long as you have enough people in the seat at that price, that means the price is right.
Right.
Sometimes you get a great manager that is, their personality is keep everything looking good, keep the books clean, but they don't really like pushing for rents. Like they just, my property's full. I want to keep my property full. And then raising rents, we might fall down. It's pretty easy math. If I get an extra $25, $50 and I'm 95% occupied versus $50 less, I'm 100% occupied, make more money at 95% occupancy every time. So you gotta kind of show folks that every now and then, and just kind of walk them to that and walk them through that, I guess. But being 100% occupied isn't always the best thing. If you're raising rents and you're 95 or you're 96, 97, keep raising rents.
Right.
The phrase around this office is, if you're 100% occupied, you're doing something wrong.
Right. That's true. You got to always kind of test the market and push the market, to see how far you can go. Yeah.
And our about technology, one of our advertising partners, Rent Vision, who we love, think they do a great job. They're pushing out a revenue product, which is a very simple revenue product that we're talking about using with them. And that is, it's just showing you basically your rent trends over your charges. And it'll show we raised rents $50. We saw a dip for 2 weeks, but we got right back onto it, and that unit style was occupied again. And so they'll show us little things like that that let us know that, hey, your rents are right because you're still occupied. And it's that kind of technology that I love to see. And there's other ones where they're showing me 1,100 pieces of data information that's just analysis paralysis. You can't figure out what they're trying to show you, and it's they're running some Black-Scholes model with 10,000 derivatives of all the people that have come through apartmentguide.com. And I'm like, look, you guys just need to go back to the keep it simple, stupid concept and just help us raise our rents, show us what makes sense, and don't just show me data to show me data. A lot of people in this business right now just want to show you data to show you data. It needs to be valuable, it needs to be digestible, and it needs to be able to move the ball forward without confusing everybody involved.
Right. Good point. All right, cool. And so I guess I want to ask you, what are you most excited about in the multifamily space at the moment?
That's a good question. I don't know. It's exciting in general. We joke that around here we're all just firemen, because there's in the property management, you mentioned boots on the ground. It definitely feels like boots on the ground most of the days. We're doing a new series with Discovery Channel where they're going to come in and film us, and we're going to have a reality show. Just kidding. We're not, but we keep joking we're going to do that because it's wildly entertaining around here, and you never know what's going to walk through the door or what's going to happen on site. I don't know. I'm excited. Just I like having some of these GP syndicators as customers. Sometimes you guys are a lot more involved, and we get to see more often, and you are a little bit more excited about it. Sometimes, and we've got guys that have been doing this for 40 years, that they buy a property, tell us it's coming. Maybe they show up, maybe they don't. Maybe they send somebody to come do a PCA, and they just kind of move on. We give them the numbers every month. Things go well. They don't even really care. They just move on to the next deal. So the young blood in the industry is kind of fun. You get to be like Tim. Tim's a good example. He found himself in this industry, and he's a nice, fun, younger guy to talk to. got to meet your group. Y'all are nice. Yeah, and like y'all came from the
Nice
same
to know.
background as me, right? Like
Yeah.
we were a bunch of nerds doing auditing, and it was like, hey, you know what's more fun is real estate because I hate paying taxes and I like write-offs. So
Mhm.
it's that kind of stuff that it's just kind of, you know, I didn't expect this industry to be as exciting as it is, but I think it's great fun. Um, and if you really, I like it. People ask me why I got here. I think it's a very simple business, and it really is.
Mhm.
You buy a property, you maintain the property, you try to get you uh, you get the most out of it by maintaining it and spending the money you need to spend by having, like I said, a little bit better property than the next guy. There's a lot of legacy people in this industry that will take a property, buy it, and just sit on it, and they'll take the cash appreciation, you know, over the years. Oh, I'm gonna sell it in 5 years, and I think that's an ignorant way to look at things because we've seen it happen a bunch of times where, you know, in this market especially, oh, I bought this property in 2018 for 45 a door. Now I'm going to get 70 a door. Well, guess what, buddy? Had you made improvements, had you kept it fully occupied, had you paid attention to your income statement and paid attention to all those expenses, you'd probably be selling it 85 a door. And so you think you've made money, but you really haven't gotten the most out of your investment. And I think a good property manager and a good asset manager is key there. And people don't understand that a lot of times. They just think as long as they made money, they did the right thing. But having those people in there to really maximize your NOI can really make you a lot more money in the end. It can make your next deal better. It can make your investors happy.
Yeah.
It can mean a lot of things for you.
Yeah, no, that's a super great point and something that we tell our investors all the time. You know, sometimes not about the deal, not even about the market, but about the team that's behind the deal,
Mhm.
right? Yeah, because they're the one that's making the decisions that are running the show. So you want to make sure you have good quality people that are behind your deals. So great
Exactly.
point.
And I'll tell you this: you've probably seen this a little bit from David and I, but we probably kill more deals than we green light. I mean,
Yeah.
and this market is tough, and everybody I know, you know, there's times where they, well, I could have made money had I bought at that price. Like, yeah, but you didn't know the future. So if things didn't turn out exactly the way they turned out, there's a lot of deals out there. Keep looking, keep finding the right deal. Just don't just buy it because there's competition and there's a frenzy and the brokers have everybody worked up. My brother's a broker and he'll hate me saying this, but those guys wear rose-colored glasses and every deal is a good deal to them because they need to get it done and they're an advocate for their clients, so they need to have that rose-colored glass on. They're trying to present it in the best light possible, and so brokers are nice guys. They're good guys. Most of them are honest. I don't think they're out there to fleece anybody, but they are pushing and advocating for that property as hard as they can because that's their job. It is your job for your investors to look at it, look at the competition, make sure the comps they're showing you are the right comps, all
Mhm.
those sorts of things, and having the right people looking at the deal is a good thing. And it's those little things that can matter.
Yep, that's precisely right. And we are similar to you guys. We are deal killers. The Sage Investing Group, we're known as like deal pokers or hole pokers
Yep.
in our group because we kill a lot of deals before they make it to the tape to our investors inbox.
Can't buy them all.
No,
Can't buy them
they
all. Just
all
make sure the
not
ones you buy
everything
are the
makes
good ones.
sense. That's right. Okay, so I guess on the other spectrum, it's like, you know, so what you're excited about. Can you tell us a little bit about what you are most concerned about in the multifamily real estate space?
I mean, everybody's probably got the same response here, and that everybody's worried the market's a little frothy, and they're wondering what's going to back up. I think there's a few insulating factors there with inflation being where it is. It's kind of that they're trying to slow down inflation with rising rates, right? So the good news is that if it's going to come more on the debt side, everybody's expecting rents to go up with inflation. Everything's going up. There's a lot of markets in the southeast that, and Memphis is a great example. Rents have not moved a lot. They've moved a lot in the last 2 or 3 years, but before then, they've been on floors for years. We would joke that there's properties that haven't had more than a 10% price increase in 20 years. I mean, they were $650 when they were made in the 80s, and you know they're still at 675 today because nothing's been done. Those legacy guys owning them, maybe it was an owner operator, maybe just kept getting sold and nobody wanted to make the improvements. People are expecting a little bit more, are willing to pay a little bit more these days. We see that when we raise the rents. We say, look, we'll give you new appliances and we'll give you new flooring and we're going to paint this thing. And people go, oh, wow, this looks just like what I see on HGTV. This is nice looking. And they like the product. We're renovating a couple of properties right now where, you know, we weren't even really advertising the renovated units yet. And, you know, you get residents coming out there, hey, I saw you guys were doing some stuff over there, peeked in there, it looked really nice. I want to know if I could transfer. And we're like, well, you know, the rent's going to be $400 more. And they're like, for that? Yeah, I'll do that. Sure. Like, that's okay. because, they had the means, like they're happy having a cheap unit. Maybe they like the location and maybe they've been there for 10 years and they've got a better job now and they're just ready for a new apartment. And instead of having to move, they can just walk across the hall. So there's little things like that where I think the world in general, the renting world is ready for the upgrades. They're ready for the new product. There's a lot of stuff that was built in the 90s and 2000s now that looks really dated, but it's got great bones. We're seeing a lot of folks buy those, go after those products and update those. And those are great. Those are easy renovations. I think people are ready for that upgrade. In the market in general, I think you're just going to see a little bit of a slowdown. And it's probably a good thing. You'd rather see it slow down than crash. And so I think with the Fed raising rates, 50 basis points at a time, whatever it's going to be, I think they're doing the right thing. I think you're going to hear from the brokers that the deals aren't, there's not 15 people in the best and final, and everybody's not just out there just, bidding it up. It's going to be 5 people in best and final, and these are people that are really looking at it hard. They're not necessarily chasing it. They've done their underwriting, and that hopefully they've made, the right assumptions about the future too. Like if you're coming in this with a bridge loan and you're going to need to get out of in 18 to 24 months with permanent debt, know that debt might be, 150 basis points higher than it is today. And hopefully that's in their underwriting, and that sort of thing will create the market that it's going to slow it down. It's going to create the atmosphere we need, and folks are going to be ready for it. So I don't think it's as scary as some people may be thinking right now. I think it's a good thing. Other aspects that might be scary. I think there's a lot of people leaving some markets, and that's why the Southeast, that's been a contributing factor to our growth. Investors and people in general are coming to the Southeast. You see, when COVID happened, had those big cities. Nashville might as well be the next, Chicago or New York. People were leaving all these places like New York, Chicago, and LA, come to a southern town. We don't have income state taxes, and we just, it's a little bit easier. It's always warmer, not as much snow. The jobs are showing up. With technology being the way it is, a lot of people are working from home. A lot of people are working in their apartments. So if you've got a big apartment or a nice apartment with good amenities, maybe if you're spending the extra 8 hours at your house every day instead of at work, maybe you want a nicer place. Maybe you're willing to spend a little bit more. So you're seeing that too. There's just a lot of, the pandemic has created some disruption in this market. And we're seeing it. I think it's mostly beneficial to us. I think it's still a great asset. I still think it's better than commercial. I think it's better than a lot of other things you can do with your money. And, as you all told your investors, cost segregations are a beautiful piece of accounting. Everybody loves them. Works well for everybody. And like I said, it's just a good field or a good investment vehicle.
Yep. Thank you so much, Brian. Really appreciate that. So we have a few minutes left. Really appreciate your insight. Anybody have any questions? I do want to open up the floor and let you guys ask any questions that you may have to Brian while we have him here today. Feel free to unmute yourself or just type it into the chat box. I think you were pretty thorough, Brian.
I don't know to talk too much.
I love all the detail. But you know what? I'm going to provide everybody with your contact information. Can you tell us how you like to be reached? I have your email here. If
Email's perfect.
People should have questions.
Yeah.
Okay. Perfect. Yeah. So if you guys have any questions that you think of after the webinar, feel free to reach out to Brian. It's at brian@multi-south.com. But yeah, well, thank you so much. I really appreciate having you on today, Brian. So good catching up with you and just kind of seeing what you're thinking and what you're seeing on the ground. So appreciate your time.
Thank you for having me, Jen. It was a pleasure. Like working with you guys. And I think one of your questions was, what do you look for in a good syndication group? And I think you guys have all those aspects. So keep doing what you're doing.
Thank you.
We look forward to doing more deals with you guys.
Yeah, we look forward to it too. We definitely enjoy working with you and the whole team and meeting everybody at the last due diligence in Alabama. So definitely looking forward to more projects together in the future. So
absolutely.
All right. Well, take care, Brian. I'll talk to you later.
All right. Thanks.
All right. Thank you, everybody, for attending. Thank you.